In plain simple terms, transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. What this means, transaction price is not always the cash price, rather this must also take into consideration discount or any other forms of concession that you give to the customer or even discount that you expect you will eventually end up giving to the customer. In other words, you don't only consider discount that you will give now, but you will also consider discount or other forms of concessions that you may offer in the future as well. This is the reason why I said transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. Transaction price can be fixed amount or a variable amount. If the amount is variable, then you should make an estimate, and once you have done that estimate, you should apply constraints to that estimate, meaning you should limit your estimate to an amount such that likelihood of revenue reversal in future is insignificant. And you keep doing a true up or true down of the variable consideration at each reporting date, and any resulting changes should be adjusted in accounts on a year-to-date basis. Transaction price can be paid in cash or in non-cash forms, for example in shares of the company. If paid in cash, no problem and no estimation needed. However, if paid in non-cash form, for example in shares, then you will need to determine fair value of the non-cash consideration at the contract inception, and only if it is not possible to determine the fair value of the non-cash consideration, only then you should determine a standalone selling price of the promised goods or service, and this estimated amount will be your transaction price. And finally, transaction price may have to be adjusted for consideration payable to the customer, or for the existence of significant financing component. Consideration payable to the customer which is not towards the purchase of distinct goods and services should be reduced from the transaction price. If consideration payable to the customer is a variable amount, then you should make an estimate of that variable amount, and that estimated amount should be reduced from the transaction price. Significant financing component may exist if consideration is paid a year before actual transfer of the goods or service or a year after the actual transfer of goods or service. Existence of significant financing component would cause transaction price to be adjusted for interest expenses or interest income. You should evaluate each case to determine if significant financing component exists, and if existence of significant financing component is due to advance payment, then transaction price will be equal to cash payment plus imputed interest expense. On the other hand, if existence of significant financing component is due to payment in future, then imputed interest income will be reduced from the cash payment to determine the transaction price. Thank you so much for watching. We'll see you soon in the next video. Thank you.